All right, today we're tackling something huge, one of the most powerful inventions in human history, the stock market. And trust me, it is an epic story. We're talking about a journey that starts with, ancient clay tablets and goes all the way to artificial intelligence. It's a tale that has literally built and broken empires and fortunes. So, picture this. Two thieves crack open a safe. Inside, you've got cash, gold bars, and a stack of paper, stock certificates. And then one of the thieves does something really strange. He ignores the cash, walks right past the gold, and grabs the paper. He wants the stocks. Now, that decision, that bizarre choice, it gets right to the heart of what we're talking about today. I mean, what is a stock, really? What is this market where they're bought and sold? And how on earth could a simple piece of paper be worth more than a literal pile of gold? That's the puzzle we're going to solve. Okay, so let's start with the basics. The very first thing you need to get your head around is that the stock market isn't really like any other market you've ever been to. Yeah, you're not there to haggle over tomatoes or kick the tires on a new car. Instead, you're trading two main things: stocks, which are just tiny, tiny slices of ownership in a company, and bonds, which are basically just IOUs. Think of it as a marketplace for money itself, for ideas, for potential, for the future. But here's the crazy part. This idea of betting on the future, of trading these abstract concepts, it isn't new at all. In fact, the blueprint for the modern stock market, well, it's literally thousands of years old. Okay, get this. We're going back almost 4,000 years. In ancient Babylon, merchants would edge partnership deals onto clay tablets to fund super risky trade caravans. And these tablets, which promised a cut of the profits, you could actually buy and sell them. Kind of like an ancient stock certificate, right? Then you fast forward to 13th century Italy. You've got city-states issuing government debt that people could trade back and forth. By 1531, things get a little more formal. Antwerp, in Belgium, opens the world's first official exchange, a real building just for trading these financial promises. So you can see the pieces are coming together, but there was still one massive, crucial piece of the puzzle missing. And the thing that finally created the first true stock, it wasn't some brilliant idea cooked up in a university. Nope, it was a gritty, practical solution to a huge life-or-death problem. All right, let's go to the 1600s. Europe is absolutely obsessed with spices from Asia. Problem is, getting them was a total nightmare. Funding just one ship cost a fortune, and you had to wait years to see if you'd get your money back. That is, if your ship ever came back at all. I mean, just think about what they were facing. We're talking pirates. We're talking catastrophic storms. We're talking rival navies just waiting to sink you. And if that didn't get you, diseases like scurvy could kill off your entire crew. So imagine you're a merchant. You sink your entire life savings into one ship, and it just disappears. Poof, gone. The risk was absolutely insane for any single person to take on. But then, in 1602, the Dutch East India Company, the VOC, had a game-changing idea. Instead of saying, hey, fund this one super risky ship, they said, invest in our entire company. They sold what they called shares to anybody who wanted to buy them, and they raised a ton of money. This meant they could send out whole fleets of ships at once, spreading out the risk. So, yeah, if one ship sank, it was still terrible, but it wasn't a total wipeout for the business. And here's the key innovation, the thing that changed everything. When you bought a share, you didn't just own a piece of one trip. You owned a piece of the whole company, forever. And just like that, the world's first publicly traded stock was born. So now we have this incredibly powerful financial tool, but it was about to collide with an even more powerful and way more unpredictable force, human emotion. And when those two things met, well, the results were explosive. Flash forward about 100 years to around 1720, and something wild happens. France and Britain have these two almost identical financial meltdowns at the exact same time. In France, you had the Mississippi Company promising just endless riches from the Americas. The stock price went through the roof. Meanwhile, across the channel in Britain, the South Sea Company promised a monopoly on trade with South America, and its stock price went bananas too. The problem? Both were built on almost pure hype. And you guessed it, both bubbles burst in the most spectacular way, ruining thousands of people and dragging their economies down with them. And this just goes to show you nobody is immune to this stuff, not even Sir Isaac Newton. Yeah, the Isaac Newton. He got swept up in the South Sea bubble. He actually got in early, made a nice profit, and got out. Smart, right? But then, he saw his friends getting even richer. The FOMO was real. So he jumped back in with his entire fortune, right at the very top. He lost everything, millions in today's money. His quote after is just perfect. He could calculate the motion of stars, but not the madness of people. Tells you everything you need to know. So this pattern, this boom and bust cycle, it just kept happening. But it hit a whole new, terrifying level in the roaring 20s in America. The economy was on fire, and for the first time ever, regular folks, your neighbors, your barber, were all piling into the stock market. The secret sauce was something called buying on margin. You could borrow a huge chunk of the stock's price, sometimes up to 90%. So with just $1,000, you could control $10,000 of stock. It felt like magic. And hey, as long as the market kept going up, everybody felt like a financial genius. And then the party stopped. On Thursday, October 24th, 1929, what we now call Black Thursday, the music just faded. The market opened and immediately plunged a shocking 11%. You could feel the panic starting to bubble up. That panic? By the following Monday, it was pure terror. The market cratered another 13%. And that's when the dreaded margin calls started. The brokers were on the phone demanding people pay back the money they'd borrowed, right now. People had to sell whatever they could to cover their debts, which just forced prices even lower, which triggered more margin calls. It was a death spiral. When it was all over, when the dust finally settled, the market was down almost 90%. Let that sink in. 90%. This wasn't just a crash, it was a complete annihilation of wealth. And it was the spark that lit the fuse of the Great Depression, a decade of misery felt all around the world. So after a catastrophe that massive, governments finally had to face a new reality. This powerful engine of the economy, you couldn't just let it run wild. It needed guardrails. It needed rules. And that's what the 20th century became about. A mix of regulation and incredible innovation. America created the Federal Reserve to be a sort of lender of last resort. After the 29 crash, the SEC, the Securities and Exchange Commission, was born to be the cop on the beat. And then technology just changed the game completely. In 1971, you get the NASDAQ, the first electronic stock market. No more screaming traders in pits, just silent, efficient computers. And by the 1980s, things got even crazier. The computers weren't just taking orders anymore. They were starting to make the trades themselves. And of course, this new tech came with new dangers. On October 19th, 1987, yep, another Black Monday, we saw exactly what could go wrong. These new automated computer programs, they were all programmed with basically the same instructions. If the market falls by X, sell. Well, the market fell, and they all started selling at once. It created this waterfall of selling that sent the market down 22.6% in one single day. It's still the biggest one-day percentage drop ever. A crash caused by machines moving way, way too fast for any human to stop. And that brings us right up to today. Because you see, the same old forces, technology and human psychology, are still locked in a dance. But now they're moving at the speed of light, and they're supercharged by artificial intelligence. The trading AIs we have now are just mind-blowing. They can make trades in microseconds. That's millions of a second. They run complex models to try and predict where prices are going next. They scan literally millions of news articles and tweets every single second just to get a feel for the market's mood. Some can even analyze the tone of a CEO's voice on a conference call to see if he sounds nervous. And the wildest part is, they're always learning, always getting smarter. So this leaves us with the big, big question for our time, right? Is all this incredible AI technology making the market smarter and more stable, or is it just a souped-up, lightning-fast way for us to make the same old human mistakes? A way to amplify greed and fear into feedback loops that spin out of control faster than we can ever possibly imagine? You know, when you look back at the 4,000-year story of the stock market, you realize it was never just about money. It's always been a mirror. Sure, it reflects the economy. But on a much deeper level, it reflects us. It reflects humanity, all of our ambition and our genius, but also all of our greed and our fear. It's all right there, captured every single day in that little flickering line on the screen. And that story is a long way from being over.